Hey everyone, and thanks for jumping back into the precious metalverse. Today, we're going to talk about gold, silver, and copper and relationships between them to better navigate financial markets. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. We also have a chat room for people who want to talk about precious metals. Link to that is in the description below as well. Let's go ahead and jump in. Now, we don't speak that frequently about precious metals on the channel. One of the main reasons is because they don't really make significant moves on a daily or even weekly basis. Even the chart in front of you that shows, a move to 1900, then back down to 1000, and then up to 2000 a few times. This took place over a decade, more than a decade, from 2011 until 2023. And there still isn't any confirmed breakout, right? I mean, maybe it'll break out beyond the all-time high, but it hasn't happened yet. Now, we don't talk about them that frequently just because there's not really a whole lot to report. But I will remind you, and this is something I've said over the last year, is that I think that precious metals like gold and silver are likely going to do relatively well over the next several years. But when you think about doing well and the time frame for that, for precious metals, they tend to move a lot slower than crypto or even stocks. But when they do move, they can move in these directions for a long time. I mean, this bull market here for gold took place from 2001 until 2011. And I mean, yes, at the end of the day, it was a move from 250 all the way up to 1900. I mean, it's a pretty attractive move for some people. That's not going to be enough. But what's interesting is that what you'll notice is that some of these big moves by gold actually took place during fairly difficult times in the stock market. So, for instance, if you were to overlay the S&P 500 onto this chart, what you'll notice is that this bull market for gold actually occurred during essentially a decade of a relatively flat returns in the S&P 500. So yes, we put in a high, we put in a low, we put in a higher high, or maybe a double top, we put in another low. During this time, gold was in a fairly massive bull market. Now, if you've only been investing for as long as I have, which is not very long in the grand scheme of things, we haven't really experienced a bull market in the same way that some people have that were invested in gold a few decades ago. This is only one bull market that you can see. I mean, there's another bull market back over here for gold that, essentially lasted from the early 70s until the early 80s. What do you know about this time? It was actually it was during a period of high inflation. So when you get these phases, and perhaps we should just throw back on the S&P 500 again, when you get these phases of relatively flat returns in the stock market, where you kind of put in highs, you put in lows, it's like higher highs, lower lows, but in general, the market isn't really going anywhere. What you'll notice is that gold during that time can do quite well, right? Gold can do quite well during that time. Now, the hard part about gold is that it can have pullbacks that can last for half a year or a year. For instance, this pullback here started in December of 74, and it didn't really hit a low until August of 76. So that's a long time, right? Now, when you zoom out, it's hard to care so much about that. But for long-term, value investors in precious metals, this still was a fairly attractive bull market. Now, one of the things I will note here as well is if you remember back to the financial crisis in 2008, gold actually had a pretty big rebound before the stock market bottomed. So if you look at where the stock market bottomed, gold actually bottomed, a bit before that. I mean, so gold bottomed here in October 2008, but we know the stock market didn't bottom until like March of 2009. So essentially about half a year, gold bottomed before the stock market did. Also note that gold started to go on this rally before the stock market bottomed as well. Here you can see that gold bottomed, I don't know if you want to say if it bottomed here in August of 99 or October 99, or maybe if you want to just take it from, say, the second bottom where the bull market really began. This occurred in April of 2001. And during that, gold started its uptrend. The S&P 500 still ultimately trended down with, of course, bear market rallies sprinkled in. But the point is that during relative, stagnant returns within the S&P 500, or during, say, a period of high inflation like we saw in the 70s, gold did pretty well. Okay, and what I want to talk about more so in sort of the short term here, if we zoom in, these are monthly candles. And if you're familiar with the bull market support band for Bitcoin, which is the 20-week SMA and the 21-week EMA, the thing I mainly use for gold is, in fact, the 20-month SMA and the 21-month EMA. Now, arguably, we had sort of a fake out right here to the downside, but recently it seems like we've held it as support on a multi-month time frame. I mean, this took place over 3 months, and now gold is starting to press higher. I have spoken a little bit about modern portfolio theory and how it relates to precious metals quite a long time ago in a video. If you want to go check that out, I will link it in the description below. It's actually been a while since I ran the numbers. If you're not familiar with what I'm talking about, it looks something like this. Portfolio optimization using gold, silver, platinum, and palladium. We went through several different examples. I'm not really sure why I was wearing a suit. I'm not really sure who I was trying to impress back then. But the point is that you can run the same types of stuff for precious metals that you can run for crypto and for equities and all that sort of stuff to just figure out, what would maximize your risk-adjusted returns. Now, the interesting thing here about gold in the short term is that it's approaching its prior all-time high. Okay, so it hasn't actually broken out of it yet. In fact, in order to do so, we need to go above 2075. You can see this one here was 2070. The one back in 2020 was 2075. So this, I believe, would be a pretty important line in the sand for us to break if in fact we can break it. Now, if we break it, then it could lead to another surge like we saw coming out of the financial crisis, like we saw coming out of the dot-com crash, and so on and so forth. Now, what I want to do is talk about how gold can often be used sort of signal whether we're going in a risk-on environment or a risk-off environment, okay? Because this is ultimately what we've talked about for quite a while. And one of the things I've mentioned is that risk assets can do well until you see either one of two things, right? The reacceleration of inflation or the real deterioration of the U.S. economy. Now, there's been a lot of people that have been screaming recession for a long time. We have said consistently for over a year that we're not in a recession yet, but it doesn't mean that one's not coming by the latter part of this year or even early next year. There's a lot of indicators that suggest one is coming, but there's also a lot of indicators that suggest we're not really in one yet. So when you think about that, it's always worthwhile to try to understand what are some risk-off signals, what are some risk-on signals. And one interesting one is actually the gold-copper ratio. So if you're not familiar with copper, so the candles here, so ignore the blue line for a minute. The candles are showing you the price action of copper. And what's interesting about copper, and we actually made a video on this a while back as well, is that copper tends to sort of lead inflation, right? So you can see that copper bottomed here in March of 2020, and then US inflation bottomed in May of 2020. And then copper peaked over here in May of 2021, and then sort of had, say, like a secondary peak. Seems like we had double peaks everywhere in March of 22. And then headline inflation actually peaked in June of 22. Now, notably, copper has moved back up to the upside recently, and we have seen some elements of inflation reaccelerating. I do think that any sustained move or any move that you see within inflation moving back up to the upside, I do think it would be relatively short-lived, because I think it's more likely we'll see disinflation as we get further into the year, as we start to feel the tightening effects by the Federal Reserve, than we are to experience hyperinflation. And you note that copper is already starting to sort of pull off here from that recent local high. Now, what's more interesting, I think, is the gold-copper ratio. Okay, and I think this is a fairly nice risk-on, risk-off signal. Let me show you what I mean. If you look at this, at the candles here that we have, this is the gold valuation divided by the copper valuation. Now we're going to be looking at monthly candles. What you'll notice is that here, when the gold-copper valuation peaked, it more or less marked the low in the S&P 500 back during the dot-com crash, right? So the dot-com crash occurred from 2000 until 2002. And when the gold-copper ratio peaked, that's actually what marked the low in the S&P 500. You'll also note that you saw a similar thing back over here as well. In February of 2009, you'll note that when the gold-copper ratio peaked, that's actually what marked around the low. I think maybe missed it by 1 month or so on the S&P 500, and so on and so forth, right? You can go through this systematically and find plenty of examples where the gold copper ratio was spiking and it corresponded to lows in the S&P 500. Now, what's more interesting than just simply looking at the peaks of the gold copper ratio is looking at what preceded them, because no one's going to tell you when the gold copper ratio is at its peak, right? At least I don't think many people are going to do that because it's so hard to know, right? But what's happening in the stock market in general if it's trending higher, right? So like over here, you can see that the gold copper ratio was trending higher from 2000 until 2002, and during that time, the S&P was in a bear market. During this phase over here, the gold copper ratio was trending higher, and again, the S&P was in a bear market, and so on and so forth, right? Plenty of examples either way. But if you were to look at what's going on today, the reason why I'm bringing this up is just simply because we've started to see the gold copper ratio break out a little bit, right? I mean, it hasn't been any major move just yet, but it is somewhat interesting to look at. And also you'll note that oftentimes when the gold copper ratio sort of at these levels over here, or putting in some type of an accumulation phase, that can actually often mark tops within the S&P 500. You'll see that time and time again, right? This sort of an accumulation range on the gold copper ratio that ultimately corresponded to the top on the S&P 500. So here's the issue, or here's the risk part of seeing the gold copper ratio go up, is that if this is a sustained move to the upside, like it was back over here during the dot-com crash, like it was over here during the financial crisis, if this is a sustained move to the upside, then it could be a risk-off warning. Okay, now I want to be clear. We've talked a long time about the implications of the policy by the Federal Reserve of raising interest rates. We said over a year ago that they're going to likely make it to at least 5% or around that time, and they have, right? They've made it to 5%. But you have to remember that it can take upwards of a year to feel the full effects of the tightening by the Federal Reserve. So far, you could argue that we've only fully felt the effects of the first 25 basis point rate hike that they did. Now, I'm not saying that the other interest rate hikes haven't been felt to some degree. Of course, they have. Mortgage rates have gone up quite quickly because of all the interest rate hikes. So I'm not saying they haven't been felt at all. But in order for a lot of the interest rate hikes to propagate through the entire economy, it can often take 12 months. And we know that we didn't even get to the 75 basis point rate hikes until closer to the summertime. So I do think there's reason to think that we are likely heading for a risk-off environment. But as I said, until we see the real deterioration of the U.S. economy, we know that in the short term, risk assets can ultimately rally, right? Until you see the unemployment rate really start to go up, until you see that jobs data really start to deteriorate, risk assets can rally in spite of a potential recession, because there's always going to be people that assume we might avoid a recession, and those people could be right? There's just simply no way to know ultimately at this point if we're going to have one or not. We've outlined the risks many times of a potential recession and what that would mean for risk assets. So I would say that the gold copper ratio is an interesting metric to track, because if this metric continues moving to the upside, like it really has been since early 2022, if this is another sustained push higher, then that could be flashing a risk-off warning in the months to come, right? Not necessarily in the days to come or the weeks to come, but say 3 months from now, 6 months from now, we could find ourselves back in a risk-off environment, assuming that this gold-copper ratio continues to move higher. Another thing to look at, I think, is silver. I've been watching silver for a while because it's been getting rejected by this downtrend line for quite some time. We've finally broken out to the upside. It's still only at 25. Still not really as high as I thought it would be by this point, to be completely honest. I mean, we have videos on gold and silver, years ago, and you would have thought they probably would have been higher at this point. But again, it is coming in at around 25. If this is finally breaking out, you might at some point look for a pullback back to, say, retest this trend line. I mean, it took forever to break out above it. So it's not that unheard of to potentially come back down and retest it. A potential retest, of course, could eventually be at $22, 22, 21. something like that. I mean, it could always do something like this and then sort of rally off of that. But the thing about gold and silver in general that I think people need to remember is that they move incredibly slowly. Okay, so for me, they represent a fairly small percentage of my overall portfolio, because if it represented my entire portfolio, then I'd likely just grow old waiting for them to actually go up in a material way and to see my portfolio valuation go up in a material way. But I do think they're good to have in a portfolio as a hedge against risk assets doing poorly, to have precious metals. I mean, it's not financial advice. For all I know, they could break back to the downside. But if we are headed for economically difficult times, then things like gold and silver could be primed to do quite well. Okay. Now again, these moves again take place over very long time frames. This downtrend here that you see that we finally broke out of, this started in February of 2021, right? This was over a 2-year downtrend. Okay, so think about it like this. I mean, if it is a breakout and silver comes up and then back tests it, I mean, the back test could be like 6 months from now, right? And then I mean, this whole process just takes forever, seemingly, for precious metals, which again is why we don't talk about them that frequently. But it's at least something to watch. And then the other thing that we could watch is the gold silver ratio. Okay. Now, the gold-silver ratio, we have a little bit of data over here, but you can kind of see that it arguably operates within some type of a range here, where for a while you'll see gold outperform silver, and then you'll see silver outperform gold. I do think that over the next decade, we're likely going to see silver outperform gold, which means that this is going to likely come back down this way. But in the short term, who really knows? I mean, maybe it would actually pop back up in the short term and then come back down in, say, the latter half of the decade. But the gold-silver ratio is always interesting. You can see that we reached, about 100, 104, 105 over here. Over here we reached like 128 or so not too long ago, back in April of 2020. But right now we're currently sitting at a gold-silver ratio of approximately 80 to 81. Note that historically, back in 69, 70, we reached gold-silver ratios of 20. So, I mean, if we were to go back to 20, that would mean that silver would be outperforming gold to the tune of 4x, right? I mean, to go from 80 to 20. So, you can kind of think about it, though, like gold is sort of like your gold and silver are sort of like the blue chips, if you will. And there's obviously a lot of other precious metals, too. But I do think in general that we should see gold and silver likely do well over the next several years. We've seen them do well. We've seen gold do well in periods of high inflation, like the 70s, right? We saw gold do well over here during periods of high inflation, and we saw it do well over here during a period where we saw relatively stagnant returns in the S&P 500. We had the financial crisis, we had the dot-com crash, and during that entire phase, gold was in just one massive bull run. So I think the question we have to ask ourselves is, are we in something like this, right? Or is this sort of the early stages of a more sustained breakout? I mean, once upon a time, we rallied back up to sort of this all-time high at around 500, or I guess it wasn't even the all-time high, but we rallied up to this local high of around 500, and then we pushed through it, and then we rallied up to this one at about 871 or 870 or so. We ultimately broke through and then continued on. But again, this entire move here occurred during a relatively stagnant market with regards to the S&P 500. And so, if you are thinking that the macro environment could lead to some headwinds that keep risk assets suppressed more than they normally are until we get inflation back down, then things like gold and silver I think are reasonable to have in a portfolio. Again, for full disclosure, I do own both gold and silver, but they are, again, relatively small parts of my overall portfolio just because they tend to move very, very slowly. Hopefully this video was insightful for you. I probably won't be making an update on gold or silver in, at least not in the short term. If we break above the highs or something, then perhaps I will. But I've become somewhat disillusioned with the precious metal market just because of how long it takes for these moves to actually occur. So if we see a breakout, and it starts to move higher, and you see the gold copper ratio start to soar, then perhaps I'll make an updated video in the next month or two. But otherwise, maybe look 6-10 months from now for another update on precious metals, just because they don't really tend to make significant movements. Again, if you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.